So imagine a judge legally orders you to pull, I don't know, 50 grand out of your IRA to pay your ex-spouse.
Right, like as part of a standard divorce settlement.
Exactly. And you do exactly what the court ordered to the letter. But then, literally the very next week, the IRS hits you with a massive 10% penalty for an early withdrawal.
Oh, man. Yeah, that happens more often than you'd think.
Right, because you followed the law, you paid exactly what you owed, but you still got trapped by this hidden mechanical tripwire in the tax code.
It's just brutal.
It really is. And today, we are looking at those exact kinds of hidden tripwires surrounding your money. Because the mechanics behind the scenes are, well, they're not always what you assume.
No, they definitely are. I mean, it is wild to really think about, but the journey of a single dollar in your retirement account is essentially a gauntlet.
A gauntlet, yeah.
Yeah. First, it has to survive the actual physical custody of the brokerage without just vanishing. Then it has to survive the hidden biases of the advisor who told you to put it there in the first place.
Right, the human element.
Exactly. Then it faces the macroeconomic forces of the next decade. And finally, at the very end, it meets the IRS waiting at the exit.
The final boss. Well, we are tracing that dollar's journey today. And to do this, we are synthesizing a pretty serious stack of heavy-hitting documents for this deep dive.
Lots of reading for this one.
Oh, for sure. We're pulling from SIPC and brokerage protection brochures, specifically from Schwab and Fidelity. We are also looking at a really detailed SEC staff bulletin on how advisors actually manage conflicts of interest.
And we've got Vanguard's deep research on something called time-varying asset allocation.
Yes, the TVAA paper. And finally, of course, we are parsing the completely unforgiving IRS guidelines on IRA distributions.
So let's just start at the very beginning of that gauntlet, right? The physical safety of the dollar itself. Because before we even consider market returns, we have to ensure the money won't just disappear if your brokerage firm goes bankrupt.
Right, because I think a lot of you listening probably assume your money at a brokerage is treated exactly like cash at a traditional bank.
Which is a very common misconception.
Yeah, because with a bank, they take your cash, they lend it out for mortgages, they pay you a little interest, and if they fail, the FDIC swoops in to save the day. But a brokerage operates under an entirely different mechanical framework, don't they?
Totally different. The foundation of a brokerage's safety actually kicks in long before any insurance policy is even involved. It's based on the SEC Customer Protection Rule.
Okay, and what does that mandate exactly?
It mandates strict segregation. So if you buy 100 shares of a company, your brokerage cannot legally use your shares as collateral to, say, fund their own corporate operations.
Or cover their own risky bets.
Exactly. Those fully paid client assets must be kept completely separate from the firm's money. They're typically held at a third-party depository.
Okay, so if the brokerage goes totally under, the general creditors pounding on the door, they just can't touch your segregated securities because they belong to you.
Right, that is the structural defense. But, history shows us that accounting failures or outright fraud, they do happen.
Yeah, Bernie Madoff comes to mind.
Yeah, exactly. Assets sometimes go missing when a firm collapses. And that is the specific scenario where SIPC, the Securities Investor Protection Corporation, steps in to make you whole.
Got it. So SIPC is basically like a digital vault.
I like that analogy, yeah.
It protects your gold bars from bank robbers, but it absolutely does not protect the value of your gold from dropping on the open market.
No, not at all.
Right,
No.
if you pick a terrible stock and it goes to zero, that is on you. SIPC only activates if the firm fails and the shares themselves are physically missing from the ledger.
Exactly. And you really have to pay attention to the coverage limits because they are highly specific. SIPC provides protection up to $500,000 per separate capacity.
Per separate capacity, okay.
Right, which also includes a $250,000 sublimit specifically for cash.
Okay, and here is a massive gotcha with SIPC that most people just completely miss. Even your cash in a brokerage account might not actually be classified as cash.
Oh, this is such a huge point.
Yeah, because a lot of uninvested money just sits in money market funds. And because those are technically mutual funds, SIPC treats them as securities, not cash.
Right.
So they actually fall under that larger $500,000 umbrella, not the smaller cash limit.
Which is actually a good thing for the investor, structurally. But it is also vital to know the exclusions. SIPC does not cover crypto assets, commodities like physical gold, foreign exchange trades, or unregistered investment contracts.
So if a broker holding those specific assets goes belly up, the SIPC vault just ignores them completely.
Yep, you are on your own there.
Wait, hold on, though. I need to stop you on the separate capacity rule.
Okay, sure.
Because you said the protection is $500,000 per separate capacity, not per account.
Right.
So hypothetically, I literally just rolled over 3 old 401ks into 3 separate traditional IRAs at my broker, mainly just because I liked having them organized by my old employers. Are you telling me those share a single $500,000 limit?
Yes, that is the exact trap people fall into all the time.
Oh, wow.
Yeah, so separate capacity refers to the legal ownership category under SIPC rules. An individual taxable account is one capacity.
Okay.
A joint account with a spouse is a second capacity. A Roth IRA is a third. You get a separate $500,000 limit for each one of those.
But the traditional IRAs.
Right. Multiple traditional IRAs at the same firm, even if they have completely different account numbers, they belong to the exact same legal capacity.
So they're pooled together.
Exactly. Meaning your 3 old 401ks now share a single $500,000 limit.
Man, that is terrifying for anyone who has been diligently saving for 30 years and, just decided to consolidate everything at one major firm for convenience.
It is scary. But major institutions like Schwab and Fidelity, they are highly aware of this anxiety. That is why they purchase what is called excess SIPC insurance.
Okay, so a private policy.
Yeah, there's a private insurance policy layered right on top of the federal mandate. And these policies often provide hundreds of millions of dollars in aggregate coverage.
Pushing the effective limits way beyond the baseline $500,000.
Right. But, relying on private excess insurance means you are trusting the specific policy terms of that firm. So understanding the federal baseline is still just non-negotiable.
Okay, so the dollar has survived the vault. The assets are segregated. The SIPC net is in place. But now we face the second hurdle in the gauntlet, the map maker. The person advising you on what to actually put inside that vault.
Right, the advisor. And the SEC has completely overhauled how we handle the motivations of these advisors.
This is the 𝗥𝗶𝗃𝗍 stuff, right?
Exactly. Regulation best interest, or 𝗥𝗶𝗃, for broker-dealers, alongside the fiduciary standard for investment advisors. The core philosophy is pretty simple. On paper, the advisor must not put their financial interests ahead of the retail investors.
But the SEC staff bulletin we reviewed dives deep into the actual mechanics of these conflicts of interest. And a conflict isn't always some, villainous backroom deal where an advisor gets a cash kickback to dump toxic waste into your portfolio.
Right. It's rarely that obvious.
It is usually a subconscious tilt.
Totally. The SEC highlights compensation structures based on total assets gathered, or sales quotas tied to proprietary products.
Or forgivable loans, right?
Yeah. Loans that an advisor only gets to keep if they move a certain number of clients over to a new firm. They also scrutinize third-party perks, things like a mutual fund company paying for an advisor's golf outing or some expensive dinner.
But for a long time, the industry standard was basically just disclosure.
Yep, just tell the client and it's fine.
Right. If an advisor handed you a 50-page packet of dense legal jargon and buried on page 42, it said, we may receive higher compensation for selling you our proprietary annuity. They were in the clear.
That was the standard, yeah.
But let's be real, nobody reads that.
Right.
You sign the last page because you trust the person sitting across the desk from you. So does a disclosure packet actually protect the client?
Well, the SEC officially concluded that it does not. Disclosure is no longer a get-out-of-jail-free card.
Thank goodness.
Right. Under 𝗥𝗶𝗃, firms are now required to actively mitigate or entirely eliminate these conflicts. You cannot just print a longer warning label.
Like what kind of things are eliminated?
For example, the SEC explicitly bans sales contests, quotas, or time-limited bonuses tied to the sale of specific securities. Those are eliminated, period.
Okay, I am curious about the mechanics of the mitigation part, though, because if they can't eliminate a conflict entirely, how does a firm actually stop an advisor from subtly pushing a product that pays them more?
So they actually have to change the underlying architecture of the compensation. Compliance departments now use back-office software to essentially cap credit across comparable products.
Interesting. Give me an example of how that looks.
Okay, let's say an advisor is looking at 2 mutual funds for your portfolio. Fund A is an outside Vanguard fund that pays a 1% commission to the firm. Fund B is the firm's own proprietary fund, and it pays a 2% commission.
So in the old days, the advisor pocketed more for selling Fund B.
Exactly. But today, the firm's compliance system must flatten that payout. The software intercepts the trade, and ensures the advisor gets credited the exact same dollar amount regardless of which fund they choose.
Wow, so you neutralize the financial incentive at the mechanical level.
You have to. You're literally stripping the bias out of the software system.
That's fascinating. Okay, so the vault is locked. The mapmaker's biases are neutralized. Now our dollar actually enters the market. We are moving from safety and advice to the mathematical engine of growth.
The fun part.
The fun part. And this brings us to Vanguard's research on time-varying asset allocation, or TVAA.
Right, and to really understand the mechanics of TVAA, we have to look at what it is replacing. Because for decades, the industry religion has been strategic asset allocation, or SAA.
So think of SAA like driving a fixed route to work every single day, completely blind to traffic. You decide you want 60% stocks and 40% bonds, and you mechanically rebalance to those exact numbers every single year, regardless of what the economy is doing.
Right, you just set it and forget it.
Exactly. And then tactical asset allocation, or TAA, is the opposite extreme. That is aggressively weaving through lanes, trying to anticipate brake lights, just hoping to save a minute here or there by timing the market.
Which rarely works out long term. But Vanguard's TVAA sits in a completely different conceptual space between those two.
Yeah, TVA is like using a GPS that ignores the daily potholes but analyzes medium-term satellite data. If it sees that a major bridge on your normal route is going to be under construction for the next 10 years, it actively reroutes you around the macroeconomic blockage.
I love that driving analogy. And the pushback to this kind of dynamic routing usually stems from a massive industry misconception that Vanguard actually calls the 90% myth.
Oh, right, based on that study from the 80s.
Yeah, the 1986 study by Brinson, Hood, and 𝗏𝗏𝗱𝗏𝗏. People misread that study to mean that your fixed static asset allocation determines 90% of your investment success.
Yeah, whenever you hear someone say, don't bother adjusting your portfolio, the static mix does 90% of the work, they are directly quoting that study out of context.
It's entirely out of context. The Brinson study actually found that the static SAA mix explains about 90% of the variance in monthly returns.
Monthly returns.
Yes, monthly. It explains why your portfolio wiggles up and down on a month-to-month basis compared to a benchmark. But it does not explain your final destination.
Ah, okay.
When Vanguard ran their own numbers, they looked at 10-year terminal wealth, like the actual physical dollar amount you end up with after a decade. And they found that while SAA explains the monthly bumps, active management strategies like TVAA explain nearly 48% of the variance in your final terminal wealth.
Explaining the wiggles on a graph is fundamentally different from explaining how much money you actually have to spend in retirement.
Exactly.
So what is the satellite data Vanguard uses to make these 10-year routing decisions? Because they use something called the VCMM, right? The Vanguard Capital Markets Model.
Right, the VCMM. And it does not try to guess what the S&P 500 will do next Tuesday.
Thank goodness.
Yeah, it's a probabilistic engine. It generates 10,000 simulated outcomes for the global economy over the next 10 years. And its primary mechanism is analyzing fair value.
Fair value, what are they looking at for that?
It looks at current 10-year Treasury yields, and it looks really closely at metrics like Robert Shiller's KP.
Right, the cyclically adjusted price-to-earnings ratio. Let's actually unpack why the cyclically adjusted part matters for a second.
Go for it.
So if you look at a traditional PE ratio during a recession, earnings have just fallen off a cliff. So the ratio spikes, making stocks look insanely expensive, which might scare you out of the market at the exact wrong time. But Shiller's KP smooths out those earnings over the past 10 years to give a true picture of valuation across a full business cycle.
Exactly. And the VCMM uses that smooth data to essentially bet on mean reversion over a decade. So if stocks are trading at incredibly high valuations today compared to their historical average, the model assumes they are likely to have lower returns over the next 10 years as they revert back to the mean. And then it adjusts the portfolio's exposure accordingly.
But the Vanguard paper stresses that TVAA is not just about chasing the highest possible return, right?
No, not at all.
The mechanism is designed to optimize the efficient frontier, which is a pretty dense term, but basically it means finding the mathematical sweet spot where you are getting the absolute maximum return for the specific amount of risk you are willing to stomach.
And how Vanguard defines risk in this model is just fascinating.
How so?
Well, most people think of risk as volatility, right? Just the ups and downs.
Yeah.
But TVAA focuses heavily on managing the 5th percentile maximum drawdown.
The 5th percentile drawdown. So if the VCMM runs 10,000 simulations, it isolates the absolute worst 500 outcomes over the next decade.
Precisely. It is analyzing the risk of a catastrophic, permanent loss of capital. When the macroeconomic indicators flash that equity valuations are dangerously stretched, TVAA mechanically de-risks the portfolio.
Wow.
It literally sacrifices some potential short-term gains specifically to protect you from experiencing that devastating fifth percentile scenario.
Okay, but I have to play devil's advocate here. This entire strategy requires you to put pretty much blind faith in Vanguard's statistical GPS.
Sure.
What happens if there is model risk? Like, what if the global economy fundamentally shifts? Say, artificial intelligence creates a permanent productivity boom and historical mean reversion just no longer applies. If Vanguard's math leads us into a lake, we are still the ones drowning.
It's a great point, and Vanguard's actually very transparent about that exact vulnerability. TVAA requires the investor to accept model risk.
Right.
The VCMM deals in probabilities, not certainties. So if the structural realities of the economy really do break away from historical patterns, the TVAA portfolio will likely underperform just a simple blind 60-40 mix.
It is a calculated bet that economic gravity will eventually apply over a 10-year horizon.
Exactly.
Okay, so the dollar survives the vault. It is guided by a conflict-free map maker. It navigates the 10-year macroeconomic cycles using the VCMM. But eventually, the goal of accumulating wealth is to actually spend it.
The best part.
Right. And that brings us to the final hurdle in the gauntlet, the exit strategy and the Internal Revenue Service.
Yeah, the IRS treats retirement accounts a bit like a roach motel. Money goes in easily, but getting it out requires navigating a labyrinth of rigid rules. And the penalties for stepping on a tripwire are uniquely punitive.
So let's loop back to the scenario I mentioned at the very beginning of the deep dive. Taking money from a traditional SEP or simple IRA before age 59.5 triggers a 10% early withdrawal penalty on top of regular income taxes.
Right, we all know that one.
But for a simple IRA in the first 2 years, that penalty jumps to an eye-watering 25%.
Which is just massive.
And people assume the IRS has a hardship exception for life disasters. If you lose your job and face foreclosure, surely they waive the penalty, right?
They do not.
No. The mechanics of the tax code do not care about your narrative. Which brings us back to the divorce trap you opened with.
Right, the family court judge.
Exactly. A judge legally orders you to split your IRA with your former spouse. If you withdraw the cash, put it in your checking account, and write your ex a check to satisfy that legal order, you have just triggered the 10% penalty.
Because the money actually touched your hands.
Yes. The IRS treats it as an early distribution to you, regardless of the court order. So what is the actual mechanism to comply with the judge without getting taxed?
It must be a direct trustee-to-trustee transfer.
Okay.
The funds must move electronically from your IRA custodian directly to an IRA established in your former spouse's name. Or, alternatively, you can formally change the name on the existing account.
So no middleman.
Right. Even an indirect rollover, where you take the cash intending to deposit it into their IRA within 60 days, that will still trigger the penalty in a divorce scenario. The plumbing matters immensely here.
Wow. And even if you flawlessly avoid early withdrawals, the IRS eventually forces your hand anyway. Once you reach age 73, you hit the required minimum distribution phase, or RMDs.
Yep, they want their taxes.
You are legally compelled to start pulling a mathematically calculated percentage out of your traditional IRAs every year, and you have to pay income tax on it. This applies even if you are still working full-time and just don't need the cash.
Which presents a massive tax drag for people who actually want to keep their money invested. But the IRS code does contain a highly effective mechanical loophole for this specific problem.
Oh.
Yeah, qualified charitable distributions, or QCDs.
Right. So starting at age 70.5, you can instruct your brokerage to send money directly from your IRA to a qualified charity. And here's why the mechanics of that are so brilliant. That direct transfer actually counts toward your mandatory RMD for the year.
But because the money goes straight to the charity and never passes through your personal bank account, it is completely excluded from your taxable income.
Which is amazing. You satisfy the IRS toll booth, you support a cause, and you artificially lower your tax bracket.
It is the perfect illustration of why understanding the structural mechanics of these rules is just as valuable as picking the right stock.
So our dollar has finally made it through the gauntlet. To recap the journey for you, we started by locking down the custody of the assets, navigating the specific limits of the SIPC vault, and the hidden danger of pooled capacities.
We vetted the map maker, learning how compliance software physically intercepts and mitigates an advisor's hidden compensation biases.
We rode out the market using Vanguard's TVAA, relying on 10-year mean reversion to avoid those catastrophic fifth percentile drawdowns. And finally, we paid the toll at the end threading the needle on trustee-to-trustee divorce transfers and utilizing charitable loopholes to minimize the IRS tax drag.
When you lift the hood and really understand these individual gears, you stop relying on the illusion of control and start building real structural resilience.
I couldn't agree more. And I want to leave you with one final thought to mull over today. We spent a lot of time analyzing Vanguard's model risk. The statistical danger that their 10-year economic forecast might just be wrong.
Right.
But what about life model risk? You can meticulously optimize your separate capacity limits, you can perfectly neutralize your advisor's conflicts, and you can flawlessly execute your charitable distributions. But if your personal goals, your health, or your family situation changes overnight, how resilient is your financial machinery?
That's the real question.
Are you building a portfolio mechanically optimized for the life you have right now? Or are you building one flexible enough to survive the life you might have tomorrow? Keep checking those screens, but make sure you understand the machine humming underneath.